Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Welcome to the latest episode of State of Economy. Today we are going to talk about macroeconomy. And all the economic indicators are showing very positive signs. It seems that economy is on a very high growth path. But there are some apprehensions too. To talk about all those things, we have with us Aditi Nayar, Chief Economist with ICRA. Aditi, welcome to the podcast.
Thank you.
Aditi, GDP number, let me start with the GDP number. There are a lot of positives. Government is very hopeful of achieving 7% plus growth for the third consecutive year after COVID. But some of the economists have some concerns on that, especially on the issue of divergence between GDP and GVA. What is your take?
Absolutely. In fact, this was a bit of a puzzling set of numbers that we got a couple of days back on the GDP and the GVA growth for Q3 of FY24. As you said, we have this big divergence on two counts. One, while the GDP growth was above 8% and it accelerated, the GVA growth slowed down between Q2 and Q3, which was in line with what we were expecting. And now there is a very sharp wedge which is there between the GDP growth and the GVA growth for the third quarter. The reason for this divergence in terms of the pure numbers is that we've had a 32% expansion in a metric called net indirect taxes, which is effectively indirect taxes less subsidies, because subsidies appear to have contracted in this quarter. And we have to keep in mind that when we talk about government finances, we work on a cash accounting basis. So the quarter in which the expense is booked is the quarter in which we are deeming that the activity has taken place. Now, clearly a 32% growth in net indirect taxes on account of a contraction in subsidies is not something which will sustain over the longer term. And we do expect that the wedge between the GVA and the GDP growth will narrow back in the subsequent quarters. But when we look at the full year numbers and we back calculate what is left over for Q4, it appears that the NSO's numbers themselves are implicitly hinting that the growth in both GDP and GVA will be less than 6% in Q4 of FY24. And I think that's something to keep in mind, that after 3 quarters of 8% plus GDP growth, the NSO itself is hinting that we're going to have a growth which is below 6% in Q4. And some of the early data for January isn't entirely positive. For example, we got a 15-month low growth in the core sector output, and we also had a contraction in both the Government of India's revenue and capital expenditure in January of 2024.
Okay. Now coming to the fiscal deficit equation, because last time there was a lot of issue that when the nominal growth will be revised, fiscal deficit will also be revised. This time, the nominal growth rate from first advanced estimate to second advanced estimate, that has been revised. If I put the figure to 296.58 lakh crore in first advance and second is 293.90 lakh crore. How do you see the fiscal maths now for the current fiscal?
So if we take the latest GDP number and we take the FY24 RE for the fiscal deficit, we're back at 5.9% of GDP, which was the original budgeted figure. And when we look at the fiscal math itself, there are positives and negatives even compared to the RE data. Possibly we are going to end up with direct taxes overshooting the RE. GST numbers are looking pretty good. Other indirect taxes may fall short, as may the disinvestment amount. But so would the capex. So as of now, when we look at what is left over for February and March for capex, the amount is looking a little too optimistic to us, and we do feel that capex itself will fall short of the target by about 50,000 crore. And possibly in some cases, we may need to have additional allocations for things like NREGA as well. Net, I don't think there is any material risk that the absolute fiscal deficit is going to be breached. And therefore, the fiscal deficit will end up being around that 5.8 or 5.9% of GDP mark. So no real major fiscal concerns at this point in time based on Government of India's data.
And if I just add it here that if you talk about the expenditure, there is a government rule which says that you cannot have more than 33% in the last quarter and 15% in the month of March. So that is one thing which we need to keep in mind when we are talking about the expenditure. Of course, the direct taxes collections are very good. Now, coming to another issue, that is the industrial growth and more specifically the manufacturing sector growth. All of us are talking about that the manufacturing growth has been very good and manufacturing is in the double digit. In fact, the GST collection data for the month of February that also showed a good growth on a Y on Y basis. Of course, on the sequential basis, it is lower. So how do you read the manufacturing sector number?
So, one thing for the manufacturing GVA growth that we need to keep in mind is that it's still showing the benefit of margin expansion because commodity prices remain a fair bit lower than what they were at the same time last year. And it's not just that volumes are growing so much. In fact, when we looked at the IIP data, volume growth of the manufacturing sector had moderated in YOY terms between Q2 and Q3. But it's the margin benefit which is still holding up, which is giving us this very healthy manufacturing GVA growth in this quarter. Now, this is possibly something that could persist in Q4 as well. However, by the time we get into Q1, commodity prices are likely to be quite similar to where they were in Q1 of FY24. So this additional margin boost is going to kind of peter away. So we may come back to seeing manufacturing GVA growing more in line with the manufacturing volumes in FY25. And that would definitely be lower than the kind of double-digit trends that we've seen in the last couple of quarters.
And coming to the GST number, now government is saying that 1.67 lakh crore is the average collection and which is the new normal. And it is also said that the GST is a consumption-based taxation. We are also seeing some kind of slowdown in the consumption, but the GST number is picking up. So is it more of a compliance than the consumption or a combination of these two?
It's a combination of consumption, compliance, and inflation to some extent. Of course, inflation is a lower concern possibly this year than what it was last year. I should say a lower contributor this year than last year. And actually, this brings me back to what we were discussing earlier, that if net indirect taxes are growing very sharply because compliance is better, should that be something that actually pushes up the GDP growth number? I'm not entirely sure. I think this is something that we need to think through as well.
Okay. Since we are talking about inflation, the next inflation number, retail inflation number, will be out March 12th. What is your expectation? Will we see some rise, or now this time we will see lower?
So, on the inflation side, we've seen quite a lot of volatility because of base effects, because of food price shocks, etc. The sense that we have is that we may end up with a number that is slightly lower than the Jan print. We will be finalizing our estimate in the next couple of days, but as of now, looks like we could be. I don't think inflation is going to harden in February compared to the Jan number. We may end up with a flattish to slightly lower number in February. And for the year as a whole, the average that we are expecting is 5.3% and then 4.6% in FY25, but completely predicated on the monsoon being normal. So our forecasts, our averages are very similar to the MPCs. And there again, they've gone with the assumption that the monsoon will be normal. And that obviously is something that we're all hoping for, but we'll get better information on as the year progresses.
And do you still stick to the rate revision estimate, revision possibility, which you said earlier, that second half of the next fiscal?
So what we were seeing up until the release of the Q3 GDP data was that if indications were that the monsoon is going to be normal, we will end up with a stance change in June, possibility of the first rate cut in August. After having seen the GDP data, I'll really be very interested to see the interpretation of the MPC as a whole and the members when we get the April policy statement as well as the minutes. Are they going to lay more emphasis on GDP growth being above 8% for 3 quarters, or are they going to be more focused on GVA growth having slowed quite sharply between Q2 and Q3? Because that is something that will then hold a very important implication for where real rates are and what real rates should be given the economic cycle, rather, I should say. And that will then give us a hint as to whether is there even any need for rate cuts to start as early as August, or do we think that they're going to be deferred beyond that? If the Q4 GDP growth print does end up being sub 6%, which we will only know at the end of May, then possibly we could still see the initial rate cut cycle expectations continuing, which is at June stance change and August rate cut. But if in May we end up with the GDP numbers that are closer to 8%, so if we continue on such a high growth path, then I certainly think that we need to revisit the need for rate cuts as early as August.
Okay. Now, my final question to you. After the GDP number was out, Chief Economic Advisor V. Ananta Nageshwaran was saying that there are three factors. One is, of course, the private sector capital investment picking up. Agriculture appears to be, it is expected that agriculture will be in a better situation next year, and the high frequency economic indicators are showing good sign. So, can we expect 7% plus growth in the next fiscal, or do you have some other number for that?
So, to my mind, high frequencies are quite mixed. We are hopeful that we will end up with a well-distributed monsoon and that the agri situation and rural demand will pick up. But that will really only show up in H2 once the monsoon is over and the Kharif harvest is hitting the market. Also, we are apprehensive that government capex could be relatively moderate in the election months, and immediately after that, even after the full budget is presented, we're going to be within the monsoon months. And typically, Government of India capex tends to be on the slower side in those months. So, capex itself would end up seeing quite a back-ended pickup in FY25. That's what we are apprehensive of. So the sense I have is that we will end up with more moderate growth prints in Q1 and Q2 with a back-ended pickup in Q3 and Q4. And I'm not sure at this point in time whether we can end up with an average which is above 7% for FY25 as a whole.
Thank you, Aditi. Thank you very much.
Thank you.